Debt and financial planning is poorly understood. On the one hand, we have Dave Ramsey telling us that all debt is bad and any suggestion otherwise is just horrible advice. On the other hand, there are many financial planners or advisors, myself included, who would tell you that the truth about debt is just not that simple. If it were just a matter of all debt is bad, there would never be a Fortune 500 company that would ever issue a bond. When a company issues a bond, they are borrowing money. They're taking on debt. And Fortune 500 companies and the Ivy League trained MBAs that run them do that all the time. So why would a company possibly worth billions of dollars borrow money, take on debt, and pay interest? Well, again, it's complicated. And if somebody tells you it's not, they're lying. All debt is bad is a grand oversimplification, no matter how many TV screens you have behind you, no matter how many cheetahs are chasing gazelles. But it is possible to learn, or at least get a basic understanding, how to make wise decisions about when to take on debt, even for someone who doesn't have a degree in finance. There are basically three concepts that you need to understand. The first is you need to know the difference between debt and equity and what those two terms really mean. The second is you need, at least on a basic level, to be able to calculate an investment return. And last, you have to understand a concept called opportunity cost. Yes, this video is probably going to be a little longer than usual, but make yourself comfortable, stay tuned. The nature of debt and the role debt plays in your financial plan, coming up. Hello, my name is Jeffrey Drayton, certified financial planner professional and founder of the Jeffrey A. Drayton Financial Group. If you're viewing this video on YouTube, don't forget to subscribe. And if you are viewing this from the vlog page of my website, go ahead and fill out the sign-up form at the top of the vlog page so that we can contact you when new content becomes available. I recently had a person tell me, you know, Jeff, thousands of very wealthy people have been studied and not one of them ever took on any debt in their life. Dave Ramsey did the research. Well, to be fair to Dave, I don't know if he ever made such a claim, or maybe something he said wasn't being completely understood. But if someone did say that, we certainly wouldn't need to read their white paper, because that is patently ridiculous. How so? Well, for starters, one of the ways that is not entirely uncommon among people who achieve very high levels of wealth is many of them started businesses that succeeded. Jeff Bezos started Amazon, Bill Gates was a co-founder of Microsoft, Elon Musk, of course, started Tesla, and SpaceX, and the Boring Company. And sometime before all of those, he co-founded a company that eventually became PayPal, and it was the money he received from the sale of his PayPal stock that he used as part of the cost to start his other companies. In other words, many wealthy people are successful business owners or founders of businesses. And starting a business is not something that is frequently done by people who are faint of taking on debt. They do it frequently and often to levels that would make most of us more than a little uncomfortable. Somebody might want to jump in here and point out that people who are starting a business aren't necessarily taking on personal debt. They probably have a business entity, an LLC, S Corp, or some such thing, and it's the business that is going into debt, not the individual. Well, maybe. But businesses, when they start out, all start out as small businesses. And small business owners commonly take on a pretty fair amount of personal debt in getting their small business off the ground. It does depend on the type of business and how capital intensive, meaning how expensive it will be to get going. But many businesses are expensive to start. So if you want to start your own business, you're probably going to have quite a bit of skin in the game. You know, there's a podcast I really like called How I Built This. It's hosted by Guy Raz. It's full of stories about people who started businesses, and a common theme is the way those people scraped together the money they needed to get their business going. Borrowing money comes up a lot. One segment tells the story of Anthony Castellanos. Castellanos started Squarespace. To do that, he borrowed $30,000 from his parents. A woman named Janice Bryan Howroyd, an African-American woman who started a company called Act One Group in 1978, now a billion-dollar company, started her company with $1,500, $600 of which she borrowed from her mom. Anyway, the point of all of this is not to tell you that to become wealthy, you need to go start a business, and the first step in doing that is to get yourself neck deep in debt. Not at all. Starting a business is a high-risk proposition. For most people, I would certainly not recommend it. But there is a valuable lesson to be learned about the very nature of debt that business owners and the way they finance their businesses can teach us, and it's something that a lot of people do not understand. It is a lesson in the type of relationship you have with a creditor when you borrow money and then use that money to go purchase something, whether that something be a business or what an average person might borrow money to buy, for instance, a home. And it's a concept business owners understand because they basically have two options when looking to finance their businesses. Two options that each have a primary upside and downside. Somewhat remarkably, that upside and downside are basically the same attribute that each of these two options have. It's just the negative and positive consequences of that attribute. Let me explain. The two options that business owners have when seeking capital to start their business, seeking capital is another way of saying getting cash, is to either borrow that money and go into debt or take on an investor. Taking on an investor means selling an ownership share in the business. Another name for ownership is equity, and therefore taking on investors is referred to as selling equity. Side note here, the two most common investments for average investors by far are stocks and bonds. When you buy a bond, you are lending money. Whether the issuer of that bond is a government or a company, what you have done is take on the role of a bank. You are lending that bond issuer money, and they will agree to pay you interest and eventually return your principal. That's what a bond is. Bonds represent debt. When investors buy bonds, we refer to this as buying debt. That's why. When you buy stock, you are becoming a part owner of a company. As I stated a moment ago, another name for ownership is equity, and therefore when investors buy stock, we call this buying equity. It is no coincidence that the two ways that businesses have available to them to get money for their business are exactly the same ways that most investors have available to them to invest their money. Investors are, by definition, people who have idle cash and would like to put that cash to work by earning an investment return. Businesses need cash, and therefore they will pay investors to use their idle cash. There are basically two relationships that investors and business owners can have. Business owners can either borrow that money and pay interest, or they can sell investors an ownership share in their business, sell equity. For the types of large publicly traded companies that average investors invest in, this is done by either that company selling bonds or issuing stock. If a small startup company wanted to borrow money, they likely wouldn't issue bonds. They would do the same thing an average person would do. They would go borrow that money from a bank. The relationship is the same. It's a debt relationship. It's just that a bond issue is complicated and probably beyond the means of a small business owner. And getting an investor would mean going to someone who has the money they can afford to lose on the type of high-risk investment that small startup companies represent. That's a special type of investor, frequently referred to as an accredited investor or a venture capitalist. If you've ever seen the TV show Shark Tank, you're seeing what taking on a venture capitalist as an investor looks like. Although in real life it wouldn't have the TV show glitz. Those people aren't lending money. They are providing their money to purchase an ownership share of the business that is being pitched to them. That panel of rich people on Shark Tank has no interest in making a loan. They're looking to buy into what might be someone else's promising sounding business. In other words, they're buying equity. So given a choice of borrowing money and going into debt or finding an investor, which is better? Each of those options has an advantage and a disadvantage. And as I said before, there's actually one attribute that debt has and one that equity has that for each is both the advantage and the disadvantage for that particular option. It's one coin, and the coin has two sides. I'll explain that in a minute. But in understanding this, you will understand the true nature of taking on debt. And that's important. I'm going to start with debt first. And in starting with debt, I'm going to start with the negative attribute of debt. Debt's downside. The downside of debt is it has to be paid back. Period. When you take on debt, whatever the terms were for that debt, when you agreed to them, they will have to be met from that point forward. Going to a bank and getting a loan likely means that you will be making monthly payments of principal and interest for the duration of the loan, however long that is, until it is paid back. There will be very little, probably no, flexibility in that. I have a friend whose son started his own restaurant. He was a chef at another restaurant. He was doing well and making nice money, but he decided he wanted the business to be his. Customers were coming just to eat his food. Why not have it be his name on the door? Anyway, a restaurant is a capital-intensive business to start, meaning it takes a lot of money. He had a budget of about $1 million just to get the doors open. He had to lease a building, hire decorators, and set up the dining area, the bar. He needed to get his kitchen outfitted, commercial-grade ovens, cooktops, food prep areas. not to mention hire a staff and get them trained. And all of this needs to be done before he has had his first customer, before he has sold a single entree, appetizer, cocktail. He's got $1 million of expenses in front of him before he has earned even one dime of revenue. Welcome to business ownership. He had about $600,000 of his own money. He needed $400,000 more. Borrowing that $400,000, assuming he can find a bank that will lend it to him, means of course he will need to start paying it back monthly. If anything goes wrong, the restaurant gets off to a slow start, it isn't producing revenue quickly enough, tough. Those payments will be due. That's the hard reality of debt. That's debt's downside. So, what's debt's upside? Well, the good news about debt is this. It can be paid back. I'll bet there are a few people who are thinking, wow, that's the upside? I get the pleasure of being able to pay this money back? Well, yes, and it's a huge upside. And if it doesn't make immediate sense to you, why? Now it's time to talk about equity. Imagine instead of my friend's son borrowing the money, he takes on an investor. Someone gives him the $400,000 he needs, and for that, they get a 40% stake in his restaurant. For equity, I'm going to switch it around. Let's talk good news first. The bad news about debt is you absolutely have to pay it back. Good times, bad times, it doesn't matter. What did my Dave Ramsey fan tell me? The debtor is slave to the master. Slavery, that's a powerful word, strong imagery. Debt means they own you. Well, does it really? But anyway, the good news about equity, you don't have to pay it back. And I don't mean you don't have to pay it back soon. You don't have to pay it back ever. Why? Because you didn't borrow anything. That person owns a 40% share of the business. They gave my friend's son money. In return, they received 2/5 ownership in his business. It's over. Done. Someone might say, well, yes, but now he needs to pay them 40% of his profits. Not necessarily. Anyone who's ever bought a growth stock knows that often companies that are in the growth cycle, what we usually think of as the early part of the business, frequently don't pay dividends. Dividends are a company paying their equity holders a share of their profits. When companies are in the early stage of their business, and companies can be in the early stage for a pretty long time, they might just tell their owners, we're reinvesting those profits back in the business. Investors generally understand this. When someone buys ownership, they are counting on that business succeeding. That's what they invested in. Trying to take profits too soon might just kill off the business and thereby make their investment worthless. Investors do not want to do that. So selling equity is great. You don't have to pay it back. As a matter of fact, you probably won't have to pay anything for quite some time. Why would anyone choose to make themselves a slave to debt? Well, there is equity's downside. Remember what I said about debt's upside? You can pay it back. Equity's upside is you don't have to pay it back, but the downside is you can't. Remember, taking on an investor means a business owner is selling a share of their business. Equity equals ownership. The investor now owns a part of the business. Debt implies no ownership. A lender owns nothing of the thing that they lent money to buy. A lender owns a contract, an agreement that you will pay back principal plus interest, but that's it. Intuitively, you already know this, but so many people get confused when applying the consequences of this principle. Imagine if my friend's son's restaurant really takes off, such that 2 years later, it isn't worth $1 million, it's worth 5 times that. He's beginning his 3rd year in business and a fair value for his restaurant is $5 million. And he decides that he wants none of the startup money that he received from others to be a part of his business anymore. No debt, no investors. Had he borrowed the $400,000 that he needed, what would it cost to get out of that relationship? What will it take to make the creditor go away? Well, that would be easy to calculate. Let's assume he was paying 8% interest and it was a 10-year loan. His first payment was due a month after he got the loan, and he has made 23 payments. At this point, he paid $54,154 of principal, $57,468 in interest, so he has paid $111,622 so far. Assuming no prepayment penalties, the balance on his loan is $345,846. He would need to pay $345,846, and his total cost for having borrowed that $400,000 is $57,468, which would have been the cost of the interest on his loan. But what would it take to make the investor go away? How much would that $400,000 cost him now? Well, the investor purchased 40% of the business, a business that is now worth $5 million. Very doubtful that the investor would be willing to accept an offer to buy his or her share of the business for $457,468, the amount of principal and interest paid on that loan. Of course, 40% of $5 million is $2 million. So how much to buy out the investor? That has a simple answer. We have no idea. Again, the investor has equity. Equity equals ownership. Ownership has privileges. And one is, you don't have to sell. It doesn't matter what the offer is. I have a friend who owns a 1971 Corvette. It's beautiful. I think what a car collector would call unrestored concours condition. His dad bought it as a present for himself when he returned from Vietnam. My friend inherited it. He plans to give it to his son someday. He gets offers for it all the time. His answer is always the same. It's not for sale. Some of the offers are for above book value, some way above. He doesn't care. He has ownership. It's his car. Ownership means just that. You don't have to sell, ever, for any price. Do you see the problem with that slave analogy for debt? The debtor is slave to the creditor. They own you. That's actually the opposite of what is true. I hear this all the time. I'm at a cocktail party and John walks up and says, Susan and I are homeowners now. We just bought a house. Well, I guess I shouldn't say we bought a house. The bank did. I'm probably not going to explain the concepts of equity and debt to John at a cocktail party, but the truth is, no, they didn't. It doesn't matter if the bank lent John and Susan 60% of the value of their house, or 80%, or somehow 120%. When you borrow money to buy a house or buy any other thing, you own that house or that thing, 100%. The bank owns a contract. Yes, the bank will need to be paid back. The downside of debt, no ifs, ands, or buts. And if you don't, they will likely foreclose. They will come take property equal to the value of what they are owed. They'll probably force the sale of the house, which they likely have a lien on as the primary piece of collateral for the loan. But confusing as it might seem, that's not ownership. If John and Susan paid $500,000 for their house, and at some point down the road it is now worth $1 million, the bank doesn't have the ability to say, you know, John and Susan, we were okay being paid back what you borrowed plus interest back when your house was only worth $500,000, but now it's worth $1 million. I'm afraid we're going to want a little piece of that pie. Sorry, bank, that's not how debt works. Now, somebody might say here, yeah, but if I borrow money to buy a house, I will pay all that interest. Had I not borrowed the money and paid that interest, obviously I will make a bigger investment return. Well, possibly, but my guess is you'll make less. And to explain why, you need to understand the second concept. You need to know a little about how an investment return is calculated. There are actually a number of formulas for calculating investment returns, and different formulas express different types of returns. But let's start with a pretty simple formula that will just give us the return on the investment, what we call ROI. The simplest version for ROI is ending value of the investment minus the initial value of the investment divided by the initial value of the investment. An example of this formula would be if I invested $100,000 initial value and it grew to $110,000 ending value, I would end up with $10,000 divided by $100,000, which would equal a 10% return. So Bob and Amy are each about to buy a house. The houses that they are each going to buy both cost $300,000. Bob decides he doesn't want to pay interest, so he chooses to pay cash. Amy, on the other hand, plans to put 10% down on the house, or $30,000, and get a 30-year loan at 3% interest for the rest. Now 5 years go by. At that point, both houses are worth $400,000, which is just under a 6% annual return. But what is the overall gain for each, Bob and Amy, that they received on their investments? Bob initially paid $300,000 initial value. His house is now worth $400,000 ending value. So $400,000 minus $300,000 is $100,000 divided by the initial value of $300,000. Bob has a 33% gain. Amy's calculation is a bit more complicated. At the point that Amy's house sells, there is the same $100,000 gain. But she has also paid close to $38,347 in interest. So the net of her gain is only $61,653. But Amy only paid $30,000 as a down payment when she bought the house and $29,953 of additional principal over the next 5 years. So her total investment was only $59,953. Amy's investment return for this holding period was 103%, about 3 times what Bob's was. This ROI, or return on investment formula, is pretty simple and doesn't require any complicated calculations or a financial calculator. However, a serious limitation of ROI is it doesn't take into consideration the holding period. Meaning, if I received a 10% return on my investment, but it took 30 years to achieve that gain, annualized, that would not be much of a return. Using a financial calculator, we can calculate the annualized or internal rate of return on both Bob and Amy's house purchases. Internal rate of return is a bit more complicated because for this we need to know what the holding period was and how much and when the different cash flows were along the timeline of the investment. In Bob's case, it's all pretty easy. Now, here I've simplified this whole house purchase example by ignoring things like transaction costs, real estate brokerage commissions, titling fees, insurance and property tax, all things that are challenging to a real estate investment. However, since we're doing a comparison between Bob and Amy's identical home purchase, I'm assuming both transactions would be affected equally, and therefore I'm disregarding that for this analysis. So Bob's timeline is he purchased his home for $300,000 and 5 years later sold it for $400,000 with no intervening cash flows along the way. The annualized or internal rate of return for his home purchase is 5.92%. which is just under 6%, the amount I indicated earlier to be the appreciation in the value of these two homes. Amy's timeline is a bit more complicated. Amy purchased the home by putting $30,000 down and then making payments on a 30-year loan at 3% thereafter. At the end of those 5 years, she sold the house for $400,000 just like Bob and then paid off the remainder of her loan. So Amy's timeline looks like this. An initial payment of $30,000, annual principal and interest expenses totaling $13,660 each year, and at the end of 5 years, just like Bob, Amy sells the house for $400,000. However, she then gives $240,047 to the bank to pay off her loan. The annualized return on this set of cash flows? Amy's internal rate of return is 16.65%, a bit less than 3 times as much as Bob's. I'm sure there are some of you who are looking at this and are wanting to bring up the point, yes, maybe all of this math makes it look like Amy somehow did better than Bob, but at the end of the day, Bob has $100,000 of gain in his pocket and Amy only has $61,653. Paying all of that interest certainly cost Amy. She is left with less than 2/3 as much money as Bob. Well, maybe, but we have no idea if that is the case. Why? Because of the third concept you need to understand to determine which was the better financial approach to Bob and Amy's home purchase transactions. And that third concept is opportunity cost. Opportunity cost is simply the cost that is incurred when you have multiple options in front of you as to how you might deploy your financial resources, and you choose an option that does not have the most favorable result. The difference between what you chose and the most favorable result is opportunity cost. The fact is, it's very difficult to always pick the best financial option for your money, and therefore we all experience some opportunity cost on a daily basis. But minimizing opportunity cost is a key component to sound financial planning. And in the case of Bob and Amy's home purchase strategies, I would be highly skeptical that Bob would have fared better than Amy. How so? Let me explain. Let's imagine that Amy didn't finance her house out of necessity, meaning because she didn't have the $300,000 original purchase price. Let's suppose she did have the $300,000, she just didn't want to commit all that cash to her home purchase. Again, whether Bob or Amy used their own cash to buy the house or borrow that money from the bank, they both own 100% of their houses. Debt and equity. When a bank makes you a loan to purchase a house, they hold debt. They don't have any equity. Amy got all the $100,000 profit of her home that Bob did. The difference was she paid $29,953 in interest. That interest could be thought of as rent that she paid the bank to use their money to buy her house instead of using her own. By doing so, she still has $270,000 available to her that Bob doesn't. Bob wanted to save that interest expense, so he committed his $300,000 to the basis, the original cost of the home. Therefore, that money is now no longer available to him. Suppose that Amy has an investment account, and that account has a moderately allocated portfolio of investments that has been producing a pretty consistent 6.5% return on her money. Because she didn't pay cash for her home, she is able to keep $270,000 in that account, the difference between the cost of her home and what she used for her down payment. At the beginning of each year, she transfers $13,660 into a money market account, which she will use to pay the annual principal and interest requirements on her loan. What will be the value of that account at the end of 5 years? Well, given those parameters and assuming her account continues to generate that 6.5% return, that account would be worth $287,093. So when Bob and Amy sell their houses 5 years after having purchased them, Bob has $400,000. He paid $300,000 for the house, he sold it for $400,000, he has a $100,000 capital gain, and therefore the original $300,000 in principal plus the $100,000 capital gain means he is now putting $400,000 into his bank account. That's the amount of Bob's net worth that is attributable to the ownership he had in this home. Amy's math is a little different. When Amy sells her house, she will also get a check for $400,000. However, she will then need to pay off the remainder of her loan with the bank, which has a current payoff cost of $240,047. This leaves Amy with only $159,953 from her home sale. However, she also has the value of her investment account, the account that she kept in reserve, continuing to produce its investment return for the duration of her home ownership. Adding the value of that account, Amy isn't walking away from her home sale with $400,000 like Bob. Amy's total net worth that is attributable to her home purchase and the finance decisions she made along with it is $447,046. She has almost half again more investment gain than Bob. Some of you might ask, how is that possible? Amy paid $38,347 to the bank in interest expense that Bob didn't pay, and yet in the end, she ended up with close to $50,000 more. It's actually not that complicated. Amy was paying the bank 3% interest to use their money in the purchase of her home, but she was earning 6.5% interest in her investment account. By choosing to pay the 3% interest expense, she avoided paying what would have amounted to a 6.5% opportunity cost expense. And there is the point of this example. When Bob and Amy purchased their houses, they were both staring into the faces of two expenses, one of which they were going to need to pay. Bob did not want to pay interest expense, so instead he chose to pay opportunity cost. Amy did the reverse, and in this example, the opportunity cost was the higher of the two expenses. By avoiding that, Amy came out ahead. Thanks everyone, I hope you enjoyed this video. Something that I'd like to point out, I am certainly not advocating taking on debt willy-nilly with no analysis as to the different scenarios and the potential costs and benefit. If that type of cost-benefit analysis is beyond your financial knowledge or skills to calculate, I highly recommend that you speak to a certified financial planner professional. And there are some types of debt that should almost always be avoided. Debt that you incur to purchase consumable items and on which you are going to pay a high interest expense will likely never make financial sense. A perfect example here would be credit card debt. But that does not mean that never taking on debt is always in your best interest. I'm Jeff Drayton. Thanks for watching. Hey everyone, as always, nothing in this video is meant to be specific advice for you. Advice like that can only be had by working with a financial planner, someone who knows you and your situation. In seeking advice, I would encourage you to speak to someone who is a certified financial planner. This is signified by the letter CFP with the registered trademark sign following his or her name. I would also encourage you to work with a fee-only financial planner. Now that's two words, fee only. Not fee-based, not fee plus commission. Both of those terms mean that the planner or advisor can receive commissions and is therefore not free of the conflict of interest inherent to commission sales. Again, I'm Jeff Drayton. Thanks for watching.